Okay, I think it's 11 a.m. and I can start the webinar. We have reserved 40 minutes only for it, so it will be quite short. If you have any questions, you can type. You can use the chat function and type questions, or you can raise the hand. There is the raise hand button also available. Okay, so my name is Jens Westerblad. I'm the CEO and co-founder of Data Partner. And the agenda today is, okay, no, it's not moving. Why it's not moving? Yeah, the agenda today is, I will start with only a very short introduction about Data Partner, one slide. And then we will spend like 10 minutes to look at the discounted cash flow methodology, like theory about making investment analysis as a basis for then we continue and we make a case in practice. We solve a case in practice by using the Invest for Excel application. I reserve like 20 minutes for that purpose. And then we continue with some questions and answers. So if you use the chat function to write any questions, I can then try to answer them at the end. It's better if you write in English rather than Bulgarian, then I can also understand them. Okay, so let's get started. First, some words about Data Partner. We are a family business established in 1987, so we've been 31 years in business, and we are located in southern Finland in Porvoo, where the star is. And we have been focusing on software for capital budgeting, financial modeling and valuation, and we have customers worldwide, so we help them optimize capital deployment and to make better decisions. In Porvoo we are a staff of 10 persons. We have a subsidiary in Sweden, and then we have some, I think, 40 business partners internationally. Like also in Bulgaria we have Angel Mirchev, CPM Consulting, here with us today, plus some other stuff that can help you. All in all, we have some 1,700 corporate customers in 54 countries. So it's quite, and we have really good references, like companies like Daimler AG and Skanska and some explained here. And as I mentioned, we focus on software for capital budgeting, financial modeling and valuation, and our main product is called Invest for Excel. It's an Excel-based add-on for modeling of finances. And we also offer training and consulting services in the field of financial modeling. Okay, then to the theory. Investment modeling, why? A business should pursue all projects and opportunities that enhance shareholder value. So you should not just continue business as it is if there's possibilities to develop and increase profitability. But of course, as you know, the amount of capital available is limited. You have limited resources and capital. You can't do everything that looks good. So the management needs to determine which projects will yield the most return over an applicable period of time. Which projects are the most profitable? You need to rank the possible investments and projects and start with the ones that are most profitable. So how do we evaluate the profitability? It's not enough to just add together the inflows and outflows, the incomes and costs. It doesn't work because the investment is in the beginning while the profits come later. And the profits come later and they are also uncertain. They're affected by risk factors. So because of the risk, the present value of future cash flows has a different value than their nominal values, especially for investors. So to determine the profitability of investments, a method called discounted cash flow is used. One cornerstone in using the discounted cash flow method is to set the correct discount rate. It's the key element. So the discounted cash flow method is the leading and most objective method, and the main elements of the discounted cash flow method are the term of the calculation, the discount rate, and the cash flows and the KPIs used in the discounted cash flow method. So these are the four cornerstones, and I will go through these four methods a little bit, these four elements a little bit more in detail. First, some words about the term of the calculation. So the term of the calculation should reflect the economic life of the object of the investment. So how long is it economically feasible to use the object? Can you use it for 5 years, 10 years, 20 years? So that's how long the calculation should be. And it's not necessarily the same as the accounting, the depreciation time, and it's not necessarily the same as the technical life expectation. You have to consider how long it's feasible to use it. And if for some reason a shorter term is used, then the residual value should be taken into account. And the residual values can be either the net market value of the objects, if you sell it, or the present value of cash flows after the main calculation term. If you continue using it for a longer period, then you should calculate the present value of the incomes, the net cash flows after the main period. Then some words about the discount rate, WACC. WACC is short of weighted average cost of capital. And that's the appropriate discount rate to be used for cash flows with risk that is similar to that of the overall firm. So for a normal type of investment or project, you can use simply the WACC as it is. And the WACC equation is the cost of each capital component multiplied by its proportional weight and then summing. Like you see here in this picture. So if, let's say the debt, you pay on average 3% for the debt in the company, and you have a corporate tax of 10%, you can deduct the interest costs in taxes, and you have in the company like 60% debt out of 100 total, and 40% is then of course equity. And if the owners that will provide the equity expect a 20% return on equity, then you calculate the weighted average cost of capital as a little less than 10%, 9.62. This picture is from Invest for Excel. And here's the formula, and the formula is explained here, but we are not going in detail to that. I have to continue. Because one other component is that the WACC is for normal projects, but then if it's some extraordinary investment, then you need to add the risk premium on top of the WACC to reflect the increased risk. Like if you invest into new business or new markets, also you need to have include the country-specific inflation, so there can be different inflations in different markets. And also if you calculate with taxes, then it's included like here, but if you calculate without taxes, then you need to remove the tax effect from the WACC. And also remember that inflation is always a part of WACC. So if you calculate a flat calculation, a real calculation without inflation, then you need to deduct inflation from the WACC. So let's say if inflation is 2%, you deduct 2% from this 962. Then the cash flow, the most important component. In order to calculate the profitability indicators like net present value, internal rate of return, and payback, we need to model the cash flow. To model the cash flow, we need to enter the capital expenditures, the investments, the incomes of the investment, the project, the additional incomes, and the operational expenses. again the marginal change in expenses from this project. And if we include taxes in the calculation, we also need to include depreciations. The best result is achieved by modeling the complete financial statements, like the income statement, balance sheet statement, the working capital statement, the cash flow statement. And this is also, by the way, how Investor Excel does it. Then the KPIs. So the performance indicators, the profitability indicators used in discount method are the most important ones are the net present value, NPV, that's the most important one, is the sum of discounted cash flows, the internal rate of return, IRR, that's just like the return on annual basis on the invested capital, the modified version of IRR, and profitability index, PI, and the discounted payback time years, payback. I don't have time to explain now in detail these ratios, but it will be included in the material that will be sent to you, or you can download it now also from the webinar page. Because now I'm going forward to make solve a case in practice, so you see in practice how you make the calculation. And for that purpose, I use the Invest for Excel application in order to save time and to ensure quality of calculation. So I close this one and I go to the program here. And so this is the starting screen of the program. It opens Excel in the background and Invest for Excel on top of it, and it replaces Excel menu with its own menu here on top, where you can access different parts of the program. And you can also switch to Excel menus. Of course, you can work with Excel menus visible all the time, because you also then have access to Invest for Excel here at the right. Or you can switch between the menus back and forth. Okay, so now when you make a calculation, you start with some basic assumptions, and then you enter the capital expenditures investment table, you model the business in income statement, you see how much working capital is needed, you get the cash flow statements, you report the balance sheet, and you see the overall profitability and profitability analysis. And then you can compare different scenarios side by side. You can make sensitivity analysis. There is graphical charts of different discount rates, different investment amounts, different income levels, different cost levels, etc. You can also create your own charts. You can make an investment proposal for the management, and you can also model financing of the investment or business. Here is user manual that opens in the language that you're running. By the way, the program has many language versions, and Bulgarian is one of them, so you can switch to Bulgarian. Or you can use it in Bulgarian and make the calculations in Bulgarian. Also the manual is in Bulgarian, and you can then convert the calculation from Bulgarian to English. But I switch back now to English in order to manage. Okay. So I start to make a calculation. I start with basic values, I start a new calculation, and now it's asking me what template to use. What I'm calculating is not impairment test, it's not a corporate acquisition, it's not evaluation of a company, but it's investment or product or business planning. So I choose number 1. Now it opens the empty template, and it asks me to name and save it. And then it stops at the calculation term. Now remember, the first component, the calculation term, how long calculation should I make? Okay, now let's assume I'm making an investment in manufacturing for machinery and equipment, and I expect that machinery and equipment to be used in like 10 years. So I make a 10 years calculation. So if I make just 10 years calculation on a basis, I put 10 and press OK. But actually now I want to also include the investment phase. In this case, there is like some 3 months for installation to take it into use. So I can make it more detailed. So I start exactly now in October 2018. I want to have it in 2 different phases. I want to call the first phase installation and then operations, and I have 3 months for installation. I want to look at that on a monthly basis to have it more detail, how I spend the money, and then look at 10 years of operations. Now I have 10 years plus 3 months. I can move the calculation point, and I can also remove the 0 period. But now I just press OK, and now it creates the calculation tables for me with 3 months in the beginning and then 10 years of operations. This was new machinery, and the gray shading is the input fields. Tabulator jumps to those. I choose to make it in one Bulgarian level. And if the discount rate is given, I just enter it, but I can also calculate it the way you saw. So let's say this company has a cost of debt, average cost of debt of 4% with 10% corporate tax. We have 70% debt out of 100 total, and 30% is in equity, and owners want 20% return on their share of the financing, and then it calculates the weighted average cost of capital of 8.5%. And I press use, calculated back. And now it's entered here, it's 8.52, and the corporate tax was also entered here. So this was some basic values. The next screen is just who made the calculation, how do you reach the person, and when was it done, and what is it about. The third page is the investment table. So here you enter the capital expenditures. So let's say you have machines, and then you have some, you have to make a building, an extra hall for this machinery. So you can add more different items here, up to 30, and then you pay according to payment schedule. You put the payments for investment. So let's say you pay 100,000 upfront. Now it should be minus, but the program will automatically react to my mistake and convert it. The minus, money out is minus in this, it's cash flow principle. And then you pay some 400,000 more at the end when it's installed and taken into use, the machinery. And let's say you pay like 50,000 per month here for the construction, 3 times like that. And then you add the depreciation. So you press the depreciation button and you choose 10 years depreciation for the machinery, straight line depreciation, asset type is machine and equipment. You start depreciating when operations commence in 2019 and you press OK. So now it calculated depreciations for the machinery. Now we do the same for the building. Let's say we use 25 years of depreciation time, 4% annually, straight line. Asset type buildings and structures, begin depreciation 2019 again, and I press OK and it calculated the depreciation of the building. Now I can also, there is some information hidden, I can change the level of detail from 3 to 4 and it will show the book value, how it will develop, so you see depreciations. And when I jump to the last period, we see that okay, the machinery is depreciated to 0, it's used until it's no longer usable, no residual value, but the building still stays there and we can put a new machine in the building. So by default we take into use the residual value of the building, which is by default the same as the book value, 90,000. Of course I cannot change it to bigger or lower or delete it, but this is by default. Okay, I can save the calculation. I continue to next screen, and this is the income statement. And now I have income rows which I can name, cost rows which I can name, and then I can create a hierarchy on how the income and costs are built up. So I name this the increased capacity. Let's call it income from increased capacity. Income from increased capacity, like that. So I can name it however I like. And then I press the button. There's a button on every line, so I can create sub-rows. Every line can be split into 99 sub-rows, and the sub-rows can again be split into detailed sub-rows. So you can build a structure on how to calculate. Let's use 3 rows now to model the income. Let's say there is the capacity of the machine is limited. It's not, you can't produce an endless amount, there is some capacity, and I multiply. So notice here is operators for each line. So I just select which operator, and then I put the utilization rate, how much of the capacity we are using, it's a percentage, and then I multiply with, no, I pressed wrong, but multiply, so I change from plus to multiplication with the price BGN per unit produced or sold. So let's say the capacity on monthly basis is like 1,000 units. So notice now I enter one number, and then there's a very handy function in the program that I can just distribute the value adjusting with numbers on months interval and press distribute. So a couple of clicks and it distributes number and automatically adjusts for how many months per column. Then let's put utilization rate. We start here in 2019 with a 50% utilization rate. Okay, I need to format it to percentage. And then again, I can distribute it with some development. Let's assume it will increase 10% annually until 2024. And then from 2024, it will only grow with 2% annually. And I distribute. So now I have it two different developments. So I see the capacity utilization rate is at the highest 87% here at the end. So never 100%. Then price per unit, if we sell this product for 123 Bulgarian lev, and let's assume that there's some price inflation of 1.5% per year. I put that visible. So I just a couple of more clicks and it distributes the price development. So now I have the incomes modeled. And remember, so to get the cash flow, I need to model the investments, the income, and the costs. So now then the costs, let's use this raw materials and consumables row and add 2 sub-rows, which would be raw materials and consumables cost per unit multiplied with, oops, wrong button again, oops, this is a little tight, multiplied with cost per unit produced. Cost per unit produced. No, sorry, wrong, no, double. Multiplied with number of units produced, like that. So let's say the cost per unit is minus 65 Bulgarian lev per unit, and there's price development of 2% annually. By the way, this change is visible here to the left, and I can change here, and the numbers change. So it's made easy that way. And then number of units produced. Okay, now remember this is an Excel-based solution, so I can use Excel formula. So I just put equals and link to those two numbers to get how many was produced. 6,000 was produced, and now I can copy the formula and also use the same button, just one click. The program automatically recognizes that it's a formula and offers to copy the formula. So now we have the units produced and the cost per unit. So we have the manufacturing costs here. And let's put some stuff. I can put it on the fixed side just to have something there also. Let's say we have a cost of 5,000 level per month for running the machine, and adjust with number of months per interval, some salary development over time, and distribute. And now we have the salaries on monthly and annual basis automatically. So now basically I almost finished the calculation. I can hide the rows I didn't need by just selecting them to be hidden. So now I have a compact calculation. I have the income. I can hide and open always the sub-calculations, which can be quite advanced with many thousands of rows, but now it's just 3 rows. So I have the income, I have the production costs, variable costs, I have the fixed costs, I have the EBIT, I didn't have the depreciation, I got the EBIT, and I have some taxes to be paid, and then the net income per period. So you see, besides the installation phase, it will be making profit every year. But it's not certain that it's overall profitable still because of the investment cost. So let's go forward. Next step is the working capital. You need to take into account the working capital because it's not just the investment cost, you also need money to run the business. So let's say you have to wait 40 days for customers to pay for your delivered products. So you have accounts receivable of some 80 to 150,000 Bulgarian lev, and then let's say you have inventory of 3 weeks of production, put 21 days, and I distribute 21 days, and it automatically calculates the value of the inventory here. But let's say you also have term of payment to your suppliers of 30 days. I distribute the 30 days to all periods, and it automatically calculates the amount of accounts payables. So actually it's bigger than the value of the inventory, so the suppliers finance the inventory plus a little bit extra. So now we have, we see how much working capital needed. So we also need like 100,000 to run the business. And the change goes directly to cash flows. This will impact, so this change goes directly to cash flows. This was needed to calculate this change in working capital. So now next screen is the cash flow statement. So you have the incomes from this project, you have the production costs, manufacturing costs, and you have the fixed costs. Taxes paid from profits, change in working capital together to make the cash flow from operations, plus you add the investments, so you have the free cash flow. So this is the cash flow. This is the row that will be used in the discounted cash flow methodology. So every cash flow is discounted to the beginning. So 420,959 in 2023 is in today's value only 274,040 because we have a high discount rate. And these discounted values are then added together. So we are in a minus position here in the beginning, but then the profits reduce the minus position, and already here in 2021 it has paid itself back, I can tell. And then also I have the bank and cash document, the total cash flow. So this is how much money I need. So some close to 700,000 needs to be financed. It can be financed with debt and equity here. You can model also the financing here in the program. If I go to balance sheet, you see also this bank and cash is, the check account is on minus because we didn't have financing. And we have the assets here, we have the machine and equipment here in tangible assets, the book values of the machine and equipment and building structures. And we have the inventory values, the accounts receivable, we have the equity, the losses and profits from operations, and we have the accounts payable here in short-term liabilities. Then I can look at the result, the final result. Is it profitable or not, this new machinery? Yes, it is. So we invest 650,000. We had a required rate of return, a discount rate. The WACC was 8.5%. The calculation term was 10 years and 3 months, starting from October 2018. So we have the present value of the operating cash flows plus the residual value. We had the residual value for the building, but it's discounted, so net effect is 100,000, and there is also some working capital included in this value. So we have the total present value is 2.6 million. We didn't have any maintenance investment, any reinvestments here, so the total present value is the same, 2.6 million. And the present value of investment were only 600,000, so the net present value is almost 2 million positive. And the return on invested capital is 45%, annually, which is higher than the required return. And then we have the modified version. The difference between internal rate of return and modified internal rate of return is that the internal rate of return assumes that the profits from this investment, when they are reinvested, give the same return, 45%, because all capital is always deployed. So it assumes that the other investments, the money profits from this investment is reinvested, give the same 45% return. Whereas the modified assumes that when the money from the profits from this investment is invested somewhere else, you get an 8.5% return. So it tells a little bit more cautiously about how much return we get. Profitability index, PI, is this present value is 4 times bigger than the present value of investments. So we sort of get our money 4 times back. So it's also something that is not depending on the size or time. So it's just a relative indicator. So it's very useful. And payback time is 3.2 years, and this is including the cost of capital. Without the cost of capital, it will be even shorter. So I can here show you what it would be. Simple payback, it's hidden because it shouldn't be used. Other menus, it will be shorter without the cost of capital, 2.8 years. But you can always here, like on every screen, you can choose what to hide and what to show. So I can also hide like indicators that I don't want to use, like this extra. And then we have a shorter version. So this was then the calculation, and let's assume this is just one alternative, so I push it to a comparison table. And we have another option, which is that we buy the machinery, but we automated machinery. So we invest a little more. Let's say it costs 100,000 more to have it automated. And we then save part of the staff cost. We don't need put as much staff. So we have also positive calculation here, and I push this to the second option so we can compare them side by side. Okay, let's see. The automation makes the net present value lower, the internal rate of return is lower, and the payback time is longer. So the automation did not pay itself back. So it was not, we shouldn't make the automation. We should stick to the unautomated version. So this way you can compare different technology, different suppliers, different competing projects side by side and choose the best one. And then you can continue with sensitivity analysis. How does different discount rates affect net present value? If you answer what discount rate to use, or what if the investment costs more, or what if you can save a little bit in the investment cost? How does it affect net present value? Or of course you can choose any indicator, not just net present value. You can use IRR. So let's see now. Stop updating. No, probably the network, or then it's the beta version. Okay, here it is. So with different IRRs, how the different investment amounts affect. And then you have the income, how much you sell, or at what price you sell. So 10% lower sales, IRR falls to 30%, 20% lower sales falls to 22%. What if we sell only half? Negative. Also, there is something we call the break-even function. I can go to any item. Let's say I take the price. How low market price can this investment take? So I select the price and I choose break-even here, or from menu, sell break-even. I choose break-even by changing the cell, and it just takes a second and it tells me that I need to get at least 85 BGN per unit. Then I'm in break even. Then I get exactly 8.52% return annually and net present value is 0 and profitability index is 1. Then I can just take undo break even and I can take any other parameter, like let's say the cost of raw materials consumables. It can go up to 103 and then just undo again. Okay, anyway, this was just a scratch. This is like 5% of the functionality in the program, so there's much more advanced functionality also. But we have a very limited time, and basically I have used my time for the theory and for the case in practice. Let's see if we have any questions in the chat. Not yet. So now, if you have any comments or questions, so now you can write it in the chat, or you can lift your hand to ask for the word, and I can give you, add audio to you, and you can speak. So, okay, here is a question, I think. Yes, I see, yeah, sorry. Okay, yes, I have recorded the web. Somebody asked, yeah, is it possible to record the webinar? And I have recorded, yes. So I can send to those who request. Any other questions? Notice that there is also 3 handouts that you can download. Invest for Excel brochure in Bulgarian. This webinar material is PDF, and also a product and company presentation, a PowerPoint in PDF format that you can now still download here for yourself. And I will, yeah, as promised, I will send a link to a test version of this program, Invest for Excel, that you can yourself test how it feels to use the program and try to make some calculation. And anyway, we are also very much willing to give private presentations to you who are interested to see more. So we can do it. We can do online presentations, and we can also visit your company, and we can do the presentations in Bulgarian language by our Bulgarian partners, or we can do it in English by me or my colleagues. So just email us or call us, and we will be in contact. Okay, I got one request here. Can you just really short tell us about the financing file? Yeah, I think that's a good idea. Yeah, I will shortly tell about the financing file. Okay, so input cash flow. Notice now that we need some 800,000 financing. It can be partly in debt. Let's say we put 100,000 equity, and the rest is debt. So I need some 700,000 in debt. So now I put input financing. I open the financing module, which is separate. It opens now, and I can name and save it, and I update to get the numbers from the calculation. I can have different currencies, but I will now make it in the, let's see, I have to make it here. PGN and PGN. and then I update like that. So what it did now, it's copying the cash flows from my calculation so that I know when I need the money and how much I need. And then I go to loan number 1, 700,000, and I need it I can take it 1 month prior in September 2018, and I need 3 months for the installation, and then I will pay back the loan in 5 years, I think. And then I enter the withdrawal, so I can put like 100,000 here and 200,000 there and 300,000 there. Oh, that was not all still. There's still 100,000 missing. Okay, make it 400,000 here. Okay, and what type of loan? What's the amortization interval? And what's the interest based on? How are interest during the construction period, investment phase? What's the reference rate? And what's the margin? And interest payment interval, let's put same 3 months. And if there are some costs, that there is a arrangement fee, which is 0.5% of the loan amount. So I just choose here how it is calculated. And then I have all the loan in detail here in tables calculated, and I also look at it as a report which I can adjust. But anyway, what I'm doing now, I'm going back to the calculation. I want to save it first. Oh, I'm messing around. Then I go back to the calculation and open the calculation, and now I just update the financing from the financing file. So now it's brought here to the calculation. So we have the loan withdrawals here, and we see that, okay, yes, there is enough money on the account, and we amortize quite fast, but it's also manages to pay the amortization. We have enough incomes from the project, and we have the financing costs here and the tax effects of those. And of course, the financing costs are also in the income statement. I've hidden the numbers, so let's take it visible here. Financing costs in income statement, and also, of course, in balance sheet I have the long-term debt and the short-term. The short-term is always next year's amortizations automatically. And this, now when I took the loan, it doesn't change the profitability, because remember, we discounted with the WACC, which also already includes the cost of capital for debt and equity. So it does not change the profitability when we add financing. And this is something that is very often done wrong, but in fact it's automatically cost corrected. So we had the financing included, but it didn't change the profitability. Okay, let's see if there are any other questions. No other questions. Okay, so Mr. Any raised hand? No. Okay, so we're already a couple of minutes over the time, so I thank you all very much for taking the time and to look into this, and please be in contact with me if you have any interest to see more and learn more. So I would be glad to help you. Thank you very much. Have a nice day, and I hope to talk to you soon again. Thank you. Bye-bye.